Hello, everyone, and welcome to my channel. And let's have a discussion today. Let's have a discussion having to do with the stock market crash of 2025. Can it happen? What could cause it to happen? I think it is fair to say that, and I don't want to get too complicated on you, right? But I think now it's time to talk, to go a little bit beyond the numbers. What is going on with the stock market? Everyone wants to is asking me, what stock should I buy? Is the stock market going to crash? What are they going to do? And like I always say to you in this channel, it's about education, it's about understanding, and obviously it's about making money at the end of the day because you don't want to waste your time learning things that you're not going to use. So let's talk specifically about the stock market crash that is about to come. How do I know? Well, we've had them in the past and we'll have them in the future. So we have one that's coming. The thing is, can you prepare for such a crash? The bottom line is this. The bottom line is this. Like any good trader will tell you, any derivatives trader will tell you that you're not here to predict, you're here to protect, you're here to make money. You're here to take advantage of what's going on. But you're not here to protect, you're not here to predict anything because you cannot predict. So let me introduce you to Mr. Mandelbrot. So an interesting video that I picked up. And it shows you a little bit about probability. It shows you a little bit really what's going on. And this book from Mandelbrot, which is the Misbehavior of Markets, it's a book about not losing money, not so much making money, and it makes a big deal out of risk. What to do with risk? What is risk? Can I predict anything? So we're gonna elevate ourselves a little bit this time around. We're gonna go beyond the day to day and try to make money and those more mundane things. Let me show you something that you should find very interesting, and hopefully, as an educator, I could explain to you in a way to make something very complex very easy to understand, right? So it comes down to calculating the risk of a market crash.
Recently, people getting worried about a drop in financial markets of 3 or 4%. But did you know it's a very real possibility markets by a much more staggering amount, such as 50%? And the reason I say this is that it's all happened in the past. According to traditional financial models, a drop of this magnitude in the S&P 500 index is practically impossible. And yet it happened in the global financial crisis.
So I guess what we're saying here is there's this concept that, what is a probability that we're going to have a stock market crash? And, can a 50% market crash happen? What is the probability? And this is where it gets interesting because whenever we say, what is a probability? Well, it's like if I take a coin and I'm asking you, what is the probability that you're going to have heads or tails? You're going to say, well, 50%, obviously. Well, but that's just the number, right? That's a probability number based on what? How can we say that this is true? This is true because of the law of large numbers. And also, it is also true because we assume a normal distribution, which is what statistics is purely based on. But I will tell you that someone did do such an example. I said, well, you know what? Let me try. Let me try to keep flipping that thing, right? They flipped it 50,000 times. And at no way in time do they get to 50-50, right? It was sometimes they lots of tails, sometimes it was lots of heads. But at the end of the day, they never got to the 50-50. Now, maybe they should do 10 million of those things. So keep in mind that you need to understand that whenever we talk about probability is not, it's based on a set of assumptions, right? So let's continue to listen to this very interesting concept.
of 2008. Nor was this the only time. The crash in 1929 was even worse. In this video, I want to explain a bit more about why estimates of the risk in finance.
You see this, what he's showing you? He's showing you a normal distribution. All the calculation that you're seeing, the likelihood that a 50% stock market crash is very small. It's almost impossible, and yet it does happen. So you got to be very careful. We got to expand our mind beyond what we already know, beyond what we call the normal probability distribution with standard deviation.
Financial markets are often wildly wrong. There are three main things I want to tell you about here. Reason number one is what Mandelbrot says about markets.
Now, Mandelbrot was a genius because he was a French mathematician, and he basically brought the idea of the fractal, right? Meaning that what is, if you look at the sky, if you look at a cloud, if you look at anything, are these patterns just purely random? Is the tree leaves the way it grows, is that random? Is there a pattern in that randomness?
The best way that I can think of to really give this a little bit more legitimacy, rather than just expecting you to take my word for it, is to tell you more about the inspirational work of the famous mathematician Mandelbrot. A lot of my interest in the behavior of financial markets comes from Mandelbrot, and in particular his work to do with fractals and chaos. His work is amazing and really game-changing. It's a very different way of thinking about statistical analysis.
So if this book, it's the one I'm talking about, the misbehavior of markets. No one wants to read a book about not losing any money. If you look at this book, right? But unfortunately, that's the kind of book you should be reading. Because otherwise, you're out there trying to predict the stock market, trying to predict the next NVIDIA, and try to see, I'm going to make money this way. What you should be understanding is that you could be making look what happened with Tesla, right? We made a boatload of money when the options went up 400%, but at what risk? And if tomorrow it could happen again, like happened in October 10th, right? The market did not like what they see in as far as the robo taxi event, and it dumped on the stocks. Then he finally got what he wanted, which is basically some numbers, and it went back up again. I mean, it's very difficult to make money that way because it's very difficult to predict the behavior of the entire market, and that's why they're talking about the misbehavior. Because if you're out there trying to run after the next behavior, good luck.
Analysis of financial markets, and as far as I can tell, still isn't really widely understood by many people giving financial advice today. Mandelbrot points out that many financial market models on the Gaussian distribution, which is the mathematician's name for the normal distribution or the bell curve. Doing so assumes that.
This is actually very simple. The bell curve basically tells you, like, listen, if this is a population of people, right? Most people in the middle will have a kind of a certain height. I don't know, like 5'5". There's going to be a small amount of people that are very tall and a small amount of people that are very short. So as long as you fit within this, then you could do a bunch of calculation.
Large price movements are rare, and catastrophic events should almost never happen. But Mandelbrot notes that the seemingly improbable happens all the time on Wall Street, with the example of a 7.7% drop in a day being quoted by him as having a probability of 1 in 50.
So the likelihood, if you use the calculation, the standard statistical, listen to me, I know it's not complicated, right? If you look at the odds of having 7.7% drop and you do this very complex statistical calculation, it tells you the odds is 1 in 50 billion. Now, the odds of you winning the lottery this week is about 1 to 350 million. We are talking 50 billion. So what? Well, it's so high that it's almost impossible. 50 billion is impossible. Okay? So it's either something else is going on or we're doing the calculation the wrong way.
Billion, according to the bell curve model. If we go to Wikipedia and look at the list of biggest declines.
So basically, he takes a look at all the declines in the stock market. And see how many times we have 7.7% drop in one day.
In Wall Street history, we see that this has happened 15 times, 3 of which were in 2020 alone. Not quite such a rare event then. Mandelbrot talks about how traditional finance.
So how could we have odds of 1 in 50 billion when, as you could see, 1987, we were down, this was a famous October 19th crash, 22%. We were down 22% in one day. And you know what? Um, one of the professor at that time went and sent out a questionnaire to 1,000 people and asked, "Hey, why did you sell on that day?" And none of them said nothing in particular caused me to sell, and they all did it at the same time. So this is a very, very complex and interesting, obviously. That's why I'm in it. Very interesting and very complex and very mind-boggling market and situation where the odds of 7%, as you could see, these are all 7%, right? We have in 1932, we have 1997, 1917, 2008, 2008, 2009, 2008. I mean, look at all these 7% drop. 1899, 8%. Obviously, the top one was 1987, where we dropped 20%. The next one was 2020 because of COVID and minus 12%. So if these are the odds of 1 to 50 billion, then either you're calculating it wrong. You are calculating it wrong.
Finance fails to account for what he calls wild randomness. It's the kind of unpredictability that saw the 1929 crash, the 1987 crash, or even more recently, the 2008 financial crisis. Mandelbrot's work shows how you need to instead use fat-tailed probability distributions to accurately assess
Fat tail. That's what you need to do. And this thing, when you show the fat tail, take a look at the video I did with Taleb Nassim. He talks about fat tail. When you do long dated, you buy long dated options, put options, you're trying to capture that fat tail. You're trying to capture that moment where the market is going to drop not 2, not 3, not 7, but maybe 10 to 20%. That's what you're looking for. This could be extremely, extremely um, um, worthy. Why? Because when this hedge fund um, from Spitznagel, which is a friend of, which is a friend of, what's his name? The guy that the guy that wrote the Black Swan. Um, Basically, what he said was that they made 4,000% at that time. So that's a lot of money.
financial market risk. But what are fat tails? If you imagine a bell curve, the tails on either side represent the likelihood of extreme events. A fat tail distribution is one where these tails extend much further out than expected by a bell.
See what's happening? They're thinking that, whoa, 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 look at the loss I'm taking here. Correct. Right? So, I'm sorry, the loss is right here. So basically, instead of being like a nice curvy thing, you get a long fat tail. You're losing lots of money here doing along. And then here you're making money. But look at that tail that you have here. That's what's hurting you.
Bell curve. This is effectively saying that the likelihood of reaching some extreme value is much higher than expected from methods based on simple bell curves. Now, this brings us to my next point. If what Mandelbrot says is really the case, why is the normal distribution so ingrained in financial modeling? Well, it's mainly for reasons of history and convenience. The normal distribution is mathematically neat and tidy and makes solving equations that you might use.
Exactly, night and tidy. They want to give you the tools so that you think you know how to calculate the risk. They told you that to calculate the value of a stock, simply calculate the capital asset pricing model. They tell you that modern portfolio theory is going to help you build a portfolio. They tell you that you need to believe in the efficient market hypothesis. all these theories that were thrown out to make you believe that you understand how to measure the risk of the stock market.
Used to estimate the risk of a portfolio much easier. Put simply, it's easier to get your head around. But it's also theoretically appealing because you only need to make one assumption to allow you to be able to justify the use of a bell curve. And that's that price changes are effectively random and independent of each other.
This means, remember what I told you about the coin toss? It's 50-50 if the way you spin the first coin has no impact on the way you spin the other one. It also means in stock prices, if Ford drops for whatever reason, it does not impact the reason why Tesla would go down as well. They are all independent events. Do you truly believe that? Do you truly believe that when one stock drops, it doesn't impact another? Because if you don't believe, then you should then obviously you need to take a look at everything all over again and realize that the price changes are not random and they are not independent. Of course, if you say this and you say, well, then how the heck am I going to predict anything? How could you say that this is going to happen one day? You can't. It's independent. No, it's not. You hear all the time, right? You hear them, well, if the Fed lower the rates, you have to lower the rates because that will impact the stock market that's going to go up. Oh, we saw with Tesla. Remember what happened to Tesla? Tesla downloaded that Tesla did well and the stock price went up. So there is a relationship here. But sometimes the stock will just drop for no reason. You happen to match it, you happen to see a correlation, but is it a causation?
What this assumption does is allow you to then use a clever piece of statistical theory called the central limit theorem. This says that regardless of the original distribution of these variables, the distribution of samples, or the price movements in this case, will tend to follow a bell curve as the sample size becomes larger. The central limit theorem therefore implies that the sum or average of asset returns over time, for example, daily returns averaged over a year, will tend towards a normal distribution. And indeed, this approach makes for a good approximation a lot of the time. You've probably heard the saying, don't try to pick the market. Well, this bell curve approach aligns neatly with that idea because you're treating price movements as unpredictable and effectively random independent. And this leads to another commonly used tool by financial market analysts, the efficient market hypothesis.
That's the best one. And basically, it says you cannot predict the market. Therefore, if you want to buy a stock, buy it because it's efficiently priced.
This hypothesis suggests that prices on the market already reflect all the available information. So there is no further information by which you could anticipate future movements. For all intents and purposes, movements can't be guessed and are assumed to be random. They then be modeled as following a random walk. That's why the efficient market hypothesis is so popular with some in the financial markets industry, because it simplifies things so much and conveniently fits with narratives about how you should invest.
Exactly. Remember, I told you about watch out who are the players, who are they talking, what are they telling you? The more you will listen to them, or the more you realize this is a big, gigantic game, and you are the turkey. In fact, there is an example of a turkey as far as stock market is concerned. But the point is, you don't want to be the turkey. You don't want them to tell you, hey, this is what's happening. This is what's causing this. This is so neatly priced. And this is how you're going to make money in the stock market. Do not believe this for 1 second. It is a lot more complicated than that.
Which brings me to my last point. Bell curves don't fit for market crashes. So how come the mathematics of bell curves don't apply here? The problem is the assumption that price movements are independent of each other. Mandelbrot, this is incorrect. He found that stock prices don't move in a well-defined series of independent random steps, like a bell curve distribution would suggest. Instead, they often move in wild, irregular jumps, which aren't easily defined by a simple, normal probability curve. And the largest price movements are often clustered together in time. Mandelbrot points out that under a random walk model, the probability of several steep falls within a short period of time becomes astronomical, something like 1 in a trillion. And yet there are many examples of this happening historically. Such consecutive runs of large movements are an example of clustering in price movements and are reasonably common. This is how, for example, the S&P 500 dropped by around 50% in a relatively short period of time during the 2008 global financial crisis. Observations of these sorts of behaviors are what led Mandelbrot to introduce the concept of fractals. Fractal mathematics is a much better description of the sort of structure that
So the answer to everything that we've seen. So if I can't believe in statistical analysis, then I should be believing in fractal analysis.
financial market price movements exhibit. And because of this, there is some small short-term correlation between price fluctuations. While most of the time this is quite a small effect, some of the time it also explains why you get such unexpectedly massive market movement. The fact that the most volatile price movements are clustered together in time is a vivid illustration of how the assumption of independence of price movements breaks down in reality. And it doesn't require any mathematics to even see it.
Now, look at the potential, right? On the day when Tesla went up, I think it went up 20%. Okay. The call on that day was up 400%. Okay. Imagine the money that you could make by buying puts way out of the money, obviously, and waiting for that 20 to 30% drop. Well, it may never happen, yeah, but if it does happen, it'll make up for all of your losses.
This, as this chart shows. And if this clustering occurs, then the central limit theorem no longer applies, and therefore the bell curve model also breaks down. Broadly speaking, Mandelbrot agrees with the idea that trying to pick price movements is not really possible for this kind of data. But his point is that risk is much higher than most models assume, and failure to estimate risk properly may result in potentially heavy losses, particularly when it comes to things like derivative pricing, but also for portfolio management. So to conclude, Mandelbrot called for a revolution in finance. He particularly warned of an overconfidence in financial models. He argues that the traditional bell curve models are far too neat and tidy. And this really opens up a new way to think about risk. Risk, according to Mandelbrot, isn't some neat little variable you can plug into a formula by measuring a standard deviation. Indeed, it's questionable whether the standard deviation is even defined for this kind of extreme data.
So, what are we saying? What we're saying is that instead of trying to make money and trying to make money on Tesla here, try to make money on Nvidia, right? What you should be doing, you should be waiting for the next crash and make money to pay for that wait. Let me explain. This is exactly what Taleb Nassim did. This is exactly where the hedge fund he worked at did. Right? Of course, it's a lot more complicated because people are going to say, "Well, we're losing money here. What the heck are you doing? We're losing money every year. We're paying for these hedges we're buying puts and we're not making any money. What's the point?" Yeah, but when you do hit, like he did in 2000, Spitznagel made 4,000%, 4,000% on his portfolio. What do you think the other guys have been averaging every year? 20%? Fine, 20%. When you make 4,000, you make up for a lot of wasted time, correct? So basically what we're saying here, and it's a different approach, instead of trying to make some money every day and be right all the time, right? That I did that. I mean, I made the same mistake when I was looking at Tesla. I said, "Well, they're gonna announce the robo taxi event. So how bad could it be, right? I mean, this car is great, the company is great. Guess what? The market says, well, the details. That's not gonna work. We don't like it. Bam. Oh no, you gave me some numbers, and Elon Musk spoke, and he says, yeah, everything is going to be fine. We're going to have all these things. The market went up 20%. That's what you want to do? Well, good luck, because you're going to have to be right a bunch of times. Now, of course, they could take $50,000. You could have put $50,000, put the money on, I guess, on the day before Tesla was released its earnings, right, and bought a call, right. So then you would have had 400% on that day. That thing went forward. So 50 times four, you probably were sitting on 250,000, and you're doing one more time, and you're a millionaire. Are you willing to bet on something like that? Now, because that's tough, right? So it's either you make money that way, or no, no, I'm going to make a bunch of calls. Yeah, I did that. I had a bunch of great calls in September. Boom, 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 boom. My portfolio was up 50%. But then I was not so right in October because of Tesla. Down again. So how could you be right all the time? Or what you can do is you say, you know what? I'm going to make just enough money so I could pay for my hedges, for my options. But meanwhile, I'm going to be loading up on some potential crash that may occur in 2025, because first, we're due for one. Second is, when it does happen, if it does happen, I will be well rewarded, because it's very cheap right now to buy options. So there's two ways to make money in the stock market. Trying to look for the next Nvidia. Uh, okay, then if you do and you're lucky and you buy, and you bought it when it was $1 and you put 1,000, now you're worth 1,000,000. Okay, but that's very, very, very unlucky. Or you keep betting to find a bunch of Nvidia. Wow, you're gonna pick the horse in the race correct every single time. That is going to be difficult. Or what you can do is you bet, or you hedge on some upcoming crash in the future. It has happened. A bunch of 7% have happened in the past. So it's not impossible. So we should have one. We had one 4 years ago, and we haven't had one. And don't forget, I've been talking about the national debt. We're talking about the elections. We're talking about, we have to refinance. We have to keep funding ourselves. Uh, we have this thing in the Middle East. But I think the crash is not going to come from something that already. It's going to come from something that nobody's talking about it right now. You need to worry about no one. And this is kind of what this channel is about. Trying to open your eyes at a different way of looking at this. Do you know who made a lot of money also like that? Um, what's his name from the movie, Michael Burry, right? Michael Burry said the market for the subprime loan is going to crash. So he bought a bunch of protection. He bought a bunch of insurance against the portfolios. And his bosses say, you're nuts. This is costing us 10 million to 12 million. Look at the movie. 10 to 12 million dollars a year, and you've been doing it for 3 years and nothing has happened. And then, of course, it crashed, and he made $500 million. The thing is, are you the kind of investors that is willing to take a chance and realize that it has nothing to do with chance? It all has to do with the risk. And it all has to do with the fact that you know that you don't know. Socrates said that. I know that I don't know. I know that I will never know. Once you know that, which is exactly what Talem Nassim said all the time, I know, I get up every morning knowing that I don't know. What I do know is that I need to protect, I need to understand risk. If you're able to understand risk, then you will protect yourself accordingly. I always have some long dated put on the market just in case. At the end of the day, I'm thinking maybe I should make just enough money to keep feeding that put, essentially. You could sell you could sell some calls, right? You could sell, and then sell options to be able to buy the puts, where you're waiting and waiting. Now, of course, you could be like Michael Berry. For 3 years nothing happens. But when it does happen, you could make a lot of money, and you're done. You go in, it's FU money. That's what we're talking about. Now, of course, if you want to have fun and, $400 here, $200 there, I mean, I'm doing that too. Nothing wrong with that. It's a lot easier. It's a lot more complicated. But obviously, I have to tell you that over time, you're not going to beat the market. They're going to beat you, right? Because you cannot be right all the time. Now, of course, I was very cautious. I made great September, October. I was overconfident, right? Because also you have to fight against your own understanding, your own emotions, right? Oh, I can't lose. This is great. Well, no, you can't lose. Well, what, it doesn't make any sense. Why did this happen? Take a look at the. If you go on my Patreon channel, I look at all the trades that I did on GCT, for example. I'm waiting for that thing to go back up. I don't understand why it's low and why ACMR is low again. They should be go. They should be booming. Although if I'm looking at the aftermarket right now, it looks like GCT is up 1% and ACMR is up as well. So maybe, but that's because I'm assuming is because they really don't believe yet the story of the small caps, right? We still love the Magnificent Seven. So maybe if the market decide tomorrow that but this is what I mean by if the market decide tomorrow that we're going to be looking at the small caps, that's only a P of 10 as opposed to keep looking at the P of 30, then we'll make money in small caps. But that's kind of what I think the picture is, what you think is happening. Trying to look at this normal distribution, but meanwhile, this thing is a lot more complicated than that. Maybe the fact that the stocks is going down, those two stocks have nothing to do with the misconception that everyone is putting money on the large cap still on the Magnificent Seven. Maybe it has nothing to do with that. You just kind of trying to conceptualize or trying to put a reality beyond what you're seeing. But as Mandelbrot mentioned, and he's a pretty smart guy. I mean, he died not too long ago, but he was a smart guy. He was a mathematician, and he basically said that it's a fool's errand to try understand that there's a lot more risk that you think. You're not seeing the risk. You're not seeing the risk. Now, if you go on YouTube, you see lots of videos about the housing and it's going to be the debt. It's going to be a bunch of things, right? So you think, oh, so these things are going to create it. Yeah. That's it. No, when it's going to come, you're not going to see it. And there's a lot. What you should think, the way you should start thinking is by believing is a lot more risk that there is that we're not measuring. All these people that you hear talking, especially from Wall Street, they use standard models, standard deviation and normal distribution, because they say, well, we have so many people that are tall, so many people that are small, so everything fits neatly. There's lots of people with lots of money, and there's small amount of people with no money at all, and smaller people with a lots of money, right? So everything is like that, right? Isn't that? No, it may not be. It may be, instead of being like this, it may be like that, meaning you have a fat tail, meaning there's a lot more people losing a lot more money than you think. So as long as you know that you do not know. So next time on Monday morning, when you look at the stock market and you hear these people talking about, oh, look, oil prices, and the stock market doesn't like oil prices because as oil goes up, it means that it's going to be bad for economy inflation, but it means also there's a lot of economic activity. So therefore, the stock market should react accordingly. Who knows? Do yourself a favor, start looking at risk when looking at investments. Don't look at the profit. Start looking at managing the risk, and you make a lot more money, because once you have a 7% drop in the stock market, good luck. Good luck. And you can take that to the bank.